Welcome back. It has been a week of very mixed signals. So, as always, we'll look at some of the biggest news from this past week, and then we'll look at some overall market metrics that tells us how investors are feeling and where they think the market is headed in the next 6 to 12 months. Then I'm going to share some of the best videos and interviews that I saw this week that should allow us to kind of see the different perspectives in the market right now during these very volatile times. And lastly, of course, I'll share what I personally bought in my portfolio that I track and share in these weekly videos. So it's been another very busy week in the market, and I just hope I can summarize it here for you in this video. However, before we get into all of that, I want to highlight Uber stock again. We're looking at a 1 month chart here, and Uber is back down almost 12%. If we zoom out a little bit, year to date, I was buying the company here in early January, like January 10th, or around that time. My average cost basis is $66. We were up almost 30% on this position not too long ago, uh, come down a little bit. So I continue to be very bullish on this one. And in this video, we're going to run some projections on this company. We'll look at, how fast they're growing, where I expect the company to be in the future, and what we're looking at in terms of estimated returns. So looking at the financial metrics here of Uber. First of all, the valuation. A trailing PE of just over 15, ridiculously low. For a growing company, the trailing PE should always be higher than the forward PE. And the forward PE should always be higher than the 2-year forward PE. This just shows how discounted this company is right now, how much bad news is already priced into the stock. Obviously, there's been a lot of worries around robotaxi and Waymo, but you might know how I feel about that. I made a whole video about Uber and my thoughts on the company 2 months ago. So go to my channel, find the Uber video if you want to learn more about that. But if we move on here, if we look at the revenue is growing almost 20%, roughly 18% a year. Very strong growth for a company that is that big, $150 billion market cap. They're still growing very well. Monthly active platform members or users just keeps growing, 14% a year. The total number of trips that they're doing, 20% growth. More and more people are taking Ubers every day, every month, every year, every quarter, whatever. If we look at their gross bookings here, these are their two main revenue streams. Mobility, so that's, ride sharing, take an Uber somewhere. 20% growth. This is the fastest growing segment of this business. Then they have delivery, which is also growing very well. 15%. It's a very, sticky habit, ordering food, ordering groceries. And I think we're getting more and more comfortable with that over time. So I expect both of those to continue to grow. And if we look at the free cash flow here, for a very long time, this was a company that burned through cash. However, they flipped to profitability. Their fixed costs kind of stopped. And, the cost of generating more revenue is low. So that's how you can see this company scale so quick. I mean, their free cash flow is growing over 100%. Obviously, that will slow down over time, but it's not showing any signs of slowing down in the short term. And the CEO, based on the latest earnings calls and some interviews, he doesn't think that it's slowing down in the short term. So before we get into the projections, I want to show you the historical price to earnings ratio here. If we look at, in the past, the company hasn't been profitable, so it's kind of a mess to look at. But if we look at the past year, early 24, company was very rich. Since then, around this time is when the peak of robotaxi and Waymo and self-driving cars kind of came out. As we know, the stock price crashed to a PE ratio of roughly, anywhere between 30 and 40. More recently, we had even more crashes in the stock price. And now the company is trading at that, 15 PE ratio. So I want to make a point for a company that's growing this quickly, assuming that robotaxi isn't going to take them out of business tomorrow. I believe anywhere from a 30 to 40 PE is reasonable for their growth rates. And with those assumptions, we're going to run these projections here. So it autofills the trailing 12-month EPS. And what we have to do is estimate what we think the company is going to grow, how fast they're going to grow their EPS moving forward, and what we think the appropriate EPS multiple or the earnings multiple or PE ratio is going to be for the company. So if we make some basic assumptions here, they're growing revenue roughly 20% a year. They have operating leverage in the company, so their fixed costs are stopped. Their expenses aren't going up, but they continue to earn more and more revenue from those costs. So more dollars are making it to the bottom line. With a company growing 20% revenue top line, should realistically be able to grow 25% easily, bottom line. And for a company growing 20% revenue, 25% earnings, they realistically should be trading anywhere from 30 to 35 in my personal opinion. So if we put a 30 PE ratio in here, it generates this projection chart here on the right side. And this is the projection, a compound annual growth rate of 42% for the next 5 years, assuming after 5 years, the PE ratio is 30. So what we're pricing into the stock here is that Waymo and Tesla isn't going to disrupt their business model. As I highlighted in my Uber video, Uber is working with NVIDIA on advancing robotaxi technology, essentially. And I think it's a very defensive move from Uber. And I think they want to ensure that there are enough providers in the space that a handful of them are going to work with Uber and take advantage of their huge network. That's the big thing about Uber for me. They have the biggest platform, the biggest network of users that are looking for, mobility and delivery. And I think, there's Tesla, there's Waymo, there's going to be Amazon, there's Cruise, there's a lot of providers. And, there's only really one player in the space currently, and that's Waymo. Waymo's the only player that is currently doing hundreds of thousands of trips a week. So if we assume that there are going to be enough players and some of them are going to partner with Uber, Uber's going to continue to grow their revenues. They're going to continue to thrive. So this is assuming that Uber is going to continue to grow for the next 5 years. And then we can play around with these a little bit. Let's say, averaged over the 5 years, they're only going to grow 20%. Let's say revenue slowed down, EPS slows down. Tesla and Waymo take market share, bring down the PE ratio too. Even with these conservative assumptions, we're still making almost 32% compound annual growth rate. And down here, I put my desired return. So I would want 15% return on my companies to outpace the S&P 500, essentially. This is also known as the discount rate. And with this discount rate, to achieve 15% return over the next 5 years, I would need to enter the stock anywhere under $141. And the stock is currently trading at $72. What if we bring the expectations down even more? And let's say we expect earnings to grow just 15%. And let's say, the PE ratio comes down to current levels and it's like a 20. Still, 20% returns a year. It's great. But for my base case, assuming that Uber is not going to get disrupted and they're going to continue to grow in both mobility and delivery, I'm going to assume a EPS growth rate of 25 and a P ratio of 30. So come 2030, I would expect this company to be somewhere around $400 a share. The point I'm trying to make here and why I want to highlight Uber here is I think Uber is the most dislocated stock, big, large cap stock in the market right now. So if you want to learn more about Uber and hear my in-depth take on the company, go back and watch my Uber video. And let me know what you think in the comments. Do you think my projections are way off here? What do you expect for the future of Uber? And do you think it's a buy today? Okay, now we can move on to news. This was not good to see. It says here that airline CEOs warn domestic travel demands is slowing. The key points here are that Delta, American, and Southwest have cut their first quarter forecasts. So they're expecting slower demand in the first quarter 2025. It also says airlines have said economic weakness and uncertainty have driven down domestic travel demand. And lastly, government travel has also slowed. So that wasn't good to hear because airline slowness usually comes with recession fears. Delta said its outlook was impacted by recent reduction in consumer and corporate confidence caused by increased macro uncertainty, driving softness in domestic demand. In addition to leisure travel, carriers have also noted a sharp decline in government travel since the start of the latest Trump administration and its policies like tariffs, government layoffs, and other cost cuts. And the Delta CEO explains that I think people are cautious and they're pulling back a little bit on travel, not in an organized manner, but just kind of waiting to see what's going to transpire, whether it's trade and tariff challenges or macroeconomic policy changes, or just a little bit of unsettledness of the market that we all see. And the United Airlines CEO pretty much agreed with that statement. So it's still early stages. We'll have to see how this plays out in the next couple months. But as the CEOs say here, they think people are just being cautious, and it's not necessarily that the consumer is super weak right now. Speaking of the consumer, that brings us to the CPI inflation data that we got this week. And this article here says that CPI inflation data cools in February, easing investors' fears about the health of the US economy. The article goes on to say February's Consumer Price Index CPI report showed inflation pressures eased in February, calming some fears about the health of the US economy during a rocky few weeks for markets. The latest data from the Bureau of Labor Statistics showed that the Consumer Price Index CPI increased 2.8% over the prior year in February, below January's 3% annual gain and ahead of economists' expectations of a 2.9% annual increase. So the number came in better than expected. The index rose 0.2% over the previous month, a deceleration from the 0.5% increase in January, and a beat compared to economists' estimates of a 0.3% monthly uptick. So overall, this was a good report. If we look at this data charted here, you'll see 22 months, we got up to the crazy 9%, right? Since then, we've been around 3%, got as low as 2.4% in September, and that's when we thought inflation was dead. But then we saw a slight uptick again into January, and now we're, at least lower than January. So honestly, inflation seems dead at this point, which is good because markets want interest rates to come down. Markets want both businesses and individuals to be able to borrow money for cheaper, cheaper mortgages, cheaper business loans. So more money can be directed into the economy and the economy can grow more. For example, if your mortgage payment is lower, you have more money to spend going out to eat, travel, buy groceries, buy new shoes, buy a new car, and so on. If you're watching this video, you'll have more money to spend on stocks. And these things all boost the economy. On the other side, if businesses can borrow money for cheaper, they can raise wages, offer better pricing, do more business with the consumers that now feel better, which drives the revenue and earnings growth of our businesses. However, and the reason this whole situation is so complicated, Trump's tariffs could be inflationary. So that's why the Federal Reserve, in my opinion, is largely holding off on cutting rates. However, again, because Trump tariffs are causing so much uncertainty and so much volatility in the market, that could be a good reason for the Federal Reserve to start cutting rates. And with the recent volatility and the uncertainty in the market, investors are expecting more cuts this year. As I said, it's very complicated and hard to pay attention to and hard to make predictions, you know, based on that. No one knows what the Fed is going to do. The Fed doesn't even know what the Fed is going to do until they look at the numbers, previous numbers, and make their decision. So we'll have to see how this all plays out. Me personally, I invest for the long term. This is short-term focused. This will be gone in a couple years, probably sooner than that, in the next year. So I continue to buy, companies at good valuations, high quality companies, companies that have and will make it through any recession if one were to come. But in all this, investors are just looking for certainty. They want to know what's happening. So that's why we're going to look at this video here titled President Trump Addresses Stock Market Turmoil. Here's what to know.
President Trump is speaking about the recent stock market volatility. Eamon Javers joins us now with more. Hey, Eamon.
Yeah, good morning, Joe. In an interview with Fox News yesterday, President Trump addressed last week's stock market turmoil caused by confusion around his tariff agenda. In one exchange, the president suggested that calls by the business community for clarity on that policy are just a talking point for the big globalists. Here's what he said.
I think that they say that. It sounds good to say. But for years, the globalists, the big globalists, have been ripping off the United States.
And asked if he's okay with the stock market going down, the president dismissed the idea of short-term focusing on the stock market.
What I have to do is build a strong country. You can't really watch the stock market. If you look at China, they have a 100-year perspective. We have a quarter. We go by quarters.
That's true.
And you can't go by that.
Now, that's a striking departure in approach from the first Trump administration when cabinet members suggested that the stock market was a good barometer for how well the administration was performing. But this is a much more populist Trump administration than in the first term, and you see that reflected by the president now dismissing stock market losses as pain for globalists, not his voter base. We'll see if Trump continues that approach later today when he's expected to meet with top technology executives at the White House. We expect the discussion there will include the president's tariff agenda, also his call to repeal the Bipartisan CHIPS Act. And guys, Andrew, I was thinking about this morning. You and I were at a dinner in New York on Thursday night where the discussion was largely around this. Just how populist is this Trump administration, and how much do these stock market losses move the needle inside this White House? And I think it's a different calculation this time than it was last time around.
So it may be different in this particular moment. The question is, if this were to persist for several months or longer, how you think that changes the dynamic, which is to say, if the stock market continues to fall as you were to walk into midterms, for example, does that change what they want to do, or do you think that they're all in?
So I think there's an intellectual group who are all in, of populist, conservative economics folks who look at this and say what we need to do is entirely restructure the U.S. economy. And the focus for too many years, too many decades, has been on lowering prices, not on families and communities. And that's really the central unit of the economy, should be the family, not prices. And you heard Scott Bessent, the Treasury Secretary, say this last week, that the ideal of the American dream is not about access to low prices, it's about other things. That's that sort of worldview. The question is how much pain Trump himself is willing to tolerate. I think the answer is he's willing to tolerate a lot more pain on the stock market, as you just heard him say, this time around than he was last time. But I don't think that's indefinite, right? I think there's some threshold larger than it was last time around at which the president might respond to stock market losses by changing course politically. I think we've got a ways to go, though, before that happens.
Yeah, it's not just how deep, but also how long.
And he can point to interest rates too, Eamon, which don't always, the bonds themselves don't always sync up with equities, and you could actually say, equities coming down, and as a result, bond prices go up with the safety, and then he would immediately talk about mortgage rates and consumer loans and all the benefits that come from that. So you can kind of have, you can pick something else to brag about if the stock market is not cooperating.
Yeah. And it's largely about jobs, right? I mean, so one conservative economist looked at this and said to me, imagine rolling back the clock to 1990 and telling somebody in a small town in the American heartland, look, in the future, your TV will cost 10 times less, but your children are going to have to move out of your town because there won't be any work for them. Would you take that deal? And he said that 90% of Americans would not take that deal, even if it meant cheaper
but
TVs
can you get the,
because
can
of
you
the
get
devastation
the
of their
jobs
community.
back? Can you get the jobs back, especially when you're talking
question.
about automation of factories at this point? I mean, and how long it takes to put some of those
that's the
things
huge
in.
gamble
How big
that
a
this administration is
TV?
making.
Like a 75-incher, or I mean, what are we
You're
talking
debating
about?
whether you'd take the deal?
I mean,
No, I would not. I would not.
I mean, how many kids do you have, right? I mean, it's that, it's that calculation too.
Exactly. Oh my God. These are really big questions when you think about it, Eamon. And here we are. We're in our little gilded cage. I mean, it really was hollowed out, the center of the country, and we do love those cheap prices, but it came at a. We'll see if prices really do rise, and it takes time to bring jobs back, and one might happen before the other, and we'll see what our actual resolve is.
Which I think you get
But
back.
I think
this
that's what
reminds
Trump.
me. Oh, go ahead. Go ahead, Eamon.
Yeah, I was just going to say, I think that's what Trump was talking about in that soundbite, where he said what you have to do is build a strong country, not look at the stock market, right? He's signaling that that's his priority, is rebuilding that industrial heartland of the United States. Now, whether that's doable or not, as you guys point out, is a huge open question. Whether it's doable in any kind of time frame that lines up with political and economic reality is another question. But that's the goal that they're setting out to do here. It's a sweeping change, and it's not the sort of Chamber of Commerce, George W. Bush Republican Party that we've seen in past decades. This is a Republican Party that's very focused, again, on family and communities and workers, and that's a totally different approach.
So there we have it, the official word from Trump. Can't look at the stock market. We have to build a strong country. So this is completely different than what investors, and myself included, were expecting. Trump using the stock market as a barometer or as a measure of his success. However, I don't know if I fully buy it yet. Is this still a negotiating tactic to get what he wants? Maybe. And then there's, as they were mentioning, is there a threshold? How long is this going to last? When we get to elections again, I personally think he's going to want a good economy, because if the stock market's hurting, the economy is hurting. What are people going to think about him when elections come around again? He might want to set up J.D. Vance for another double term, and if that's the plan, they want, obviously, the economy to be good, people to feel good about them. They're making more money in the stock market under them. So as I said, I don't know if I fully buy it yet. We'll have to see. Moving on, here's another thing I wanted to show you. So this is the margin debt, essentially how much margin people are using in their investment accounts, how much debt people are using to invest, borrowed money, right? And historically, this has been a pretty good indicator of a market top. You'll see here in 21, margin debt peaked shortly after we had the 22 crash. And recently, we've been getting to very high levels. This was from January. We know what happened in January. Some of those, high-flying stocks like Palantir, Tesla, Hims, Robinhood, some of them are already down 40, 50%. And I saw this chart here. This is from 66 to 2016, it looks like. Every time margin debt peaks, it typically lines up with a market peak. So it just goes back to the psychology of investors. When things are good, they can't see the bad things. They start loading up on margin, saying, oh, why can't I make more money? And that tends to be when things start breaking. So just something to be aware of. There's no saying that this can't go higher. We've already seen a correction, I would say, in the start of this year. So we'll keep an eye on this and see where it trends. Maybe it'll go up again, maybe it'll go down. We'll see. Another thing I like to look at is the put to call ratio. And you'll see that it's now reaching 1.5, which historically, when the put to call ratio spikes, we're near a bottom. As you can see, it kind of lines up. And as this account here highlights, historically this has been a turning point for the S&P 500. So based on this, maybe the we've already reached the bottom. And just to explain what this means, I pulled this up, Investopedia, put to call ratio meaning and what it says about how to gauge the market. So what is a put to call ratio? The put call ratio is a measurement that is widely used by investors to gauge the overall mood of a market. So are people bullish or are they bearish? Positive or negative? A put or put option is a right to sell an asset at a predetermined price. A call or call option is a right to buy an asset at a predetermined price. If investors are buying more puts than calls, it signals a rise in bearish sentiment, which we've seen in the past couple weeks. And based on that chart that we just saw, maybe we've reached the peak of that bearishness. And then it says if they are buying more calls than puts, it suggests that they see a bull market ahead. And typically you should see more calls than puts. You should see a low put to call ratio because generally the market goes up. So those were two things that I like to look at from time to time. As I've said before, I don't pay too much attention to those, macro level things because, none of them are fully accurate. It's hard to, make accurate predictions consistently. I just buy high quality companies and think about the valuation, especially during, overvalued times like December, January. But let's see what Tom Lee has to say about this whole situation.
This guest says the markets will find their footing before April 2nd, when the reciprocal tariffs, at least for now, are set to take effect. Joining us now for more is Tom Lee. He is the head of research and founder of FundStrat, also a CNBC contributor. Also joining us, Nancy Tangler, Laffer Tangler Investments, CIO and CEO. Tom, listen, I understand it's a different White House. Every day we get a market-moving headline. A lot of people, I think, honestly, I'm just going to say it, they don't want to be neutral. They don't want to be data-driven. They want to be angry. I get that. But history says that markets will recover, right?
Yes, they've recovered every time. One thing we have to keep in mind is when markets fall this quickly from a 52-week high, I mean, just remember, less than a month ago, we were at all-time highs. That is a market pricing in a crisis. I'd say we're almost 50% pricing in a recession, and we're assuming there's no Fed put. Now, the Fed is in a position to cut rates. That really should mitigate the downside. And I do think two other things that investors have to keep in mind, because many people just want to get out until April 2nd, is number one, I do think there's a very high probability that a tariff solution happens before the next 3 weeks happens. And it's simple to see because China, Europe, Canada, Mexico, since April 18th, all of those countries have outperformed the U.S. I don't think that markets are that blind to say if Canada and Mexico are about to have a recession, they should outperform the U.S. And I think the second thing people should keep in mind is that when you have a global crisis brewing, and we highlighted like the 1962 Cuban Missile Crisis, that was a 12-day crisis, but the markets bottomed 7 days into the crisis. 5 days before that crisis ended, the market was already recovered 2/3 of the losses.
And that was only, Nancy, nuclear holocaust. I mean, that literally was, we're going to break the world in half with ICBMs. I mean, that was, compared to tariff worries and a slowdown in the economy because we might slap something on European wine or steel, seems very small now. That said, again, and I'm not saying the markets are going to recover next week. I don't know. We're talking about history, and I don't like to bring up politics, Nancy. It always makes me feel like I need a shower, but I will ask you this. How much of this correction that we are seeing do you think, 100%, 50%, 0%, is political, is man-made, is tariff-made?
It's funny you asked that, Brian. It's good to see you. If you look at the consumer sentiment numbers today, and I commend everyone to read Kelly's piece that she wrote this morning, but if you look at behind it by political party, what you see is that Democratic sentiment has not been this low, especially on expectations, ever. And so if you look sentiment overall by party, Democrats down from 91.4 all the way down to 41.4, while independents and Republicans are down somewhat but have held up. And then on expectations, down from 28.2 down from 93.1 to 28.2. So that's driving some of these sentiment numbers that the market's keying off of. And I would just point out that the bond market is not panicking. And so this notion that we're going to go into recession because the Atlanta Fed GDP Now number was revised down, that was driven by imports. They were up 70% in January as purchasing managers trying to get in front of tariffs. So I think just like in 2022, this will all settle in. We are seeing decelerating growth, but that's good for many of the names that have been punished, the reliable earnings growers in technology and consumer discretionary and some financials even. So I think we will continue. This is a correction. We needed one. We get one every 12 months. And so now the question is, have we hit the bottom? Do we have a little more to go? But I don't think we're in a bear market.
So those two clearly have a more relaxed outlook on the whole situation and seem to think that a lot of the negativity is already priced in at this point. I mean, Tom Lee mentioned that he thinks that even as much as 50% of a recession is already priced in at this point. And keep in mind, look at any crash in the past few years and look at how quick the recovery is. So at this point, it may be a bad idea to get out of stocks until this whole situation has settled, because remember that the market bottoms before the bad news peak. And right now, everyone is waiting for those April 2 reciprocal tariff announcement to come out. But I personally wouldn't be surprised if we've already recovered a lot of the losses by then, like Tom Lee mentioned in the video. And as always, none of this is financial advice. This is how I personally see the situation. I may very well be wrong. Let me know what you think in the comments. And lastly, here's what I bought this week. I bought 48 shares of SoFi at $11.19. I made a whole video on SoFi earlier this week, talking in depth about what I think about the company now, moving forward. And they saw a pretty significant dip recently. But that'll be it for this video. I continue to buy the weakness every single week, and I believe in these companies for the long term, so I'm not going to let the short term affect that. But I hope you enjoyed the video. Let me know in the comments below if you did. See you in the next one.